everyone. I'm really excited to be here with you today. My name is Summer Wilkinson, and I'm the owner and founder of LeafBook CFO Services, a virtual tax and accounting firm that provides fractional CFO services, accounting, tax preparation, and profit coaching. I'm a certified Profit First professional, and I'm passionate about advancing the financial health of today's entrepreneur. So the presentation today I'm calling It's Your Business. Shouldn't your profit come first? And before we jump in, I want to just ask a few questions and see if you can identify with any of this. Have you ever wondered why your accountant tells you that your profit is more than you have in your bank account? Do you panic at tax time because you don't have enough money to pay your income taxes every year? Do you often forgo your own paycheck in order to make sure your employees get paid? Or do you forgo a paycheck so you can put every dime back into growing your company? Can you relate to the phrase entrepreneurial poverty? I think I can relate to all of these questions. So in this presentation, I'm going to introduce you to the Profit First system based on the book Profit First by Mike Michalowicz. Profit First puts a system in place that puts profit first, ensures adequate cash flow for your business operations, ensures that the business owner receives a regular paycheck that can sustain your way of life, and it also ensures that you have enough funds set aside for income taxes so you don't have to panic at tax time anymore. While the system itself is simple, implementation may not always be simple. Well, why do I say that? One factor, human nature. Change is hard and most people are resistant. Implementing Profit First in your business may cause you to face some hard truths about your business, and it might make you feel a bit uncomfortable. But I can tell you from personal experience that any discomfort is worth it. All right, let's get into it. According to the Small Business Administration, there are 30.7 million small businesses in the U.S., which accounts for about 99.9% of all U.S. businesses. Unfortunately, more than 50% of small enterprises fail in the very first year, and more than 95% of these small startups fail within the first 5 years. So what that tells us is that these businesses are operating check to check, and these business owners are one catastrophe away from closing their doors permanently. And maybe prior to 2020, you might think that might have been an exaggeration, but I think after COVID, that is a hard truth. So these statistics they're discouraging, but really they shouldn't be, because while we know these statistics, I have a hard time saying statistics, I'm sorry. We know why these businesses fail. The number one reason that businesses fail in the U.S. is lack of cash flow. Business owners simply do not have enough cash to run their businesses. Now, there may be multiple complicated reasons behind this: slow sales, a bad management team, a sales pipeline that doesn't stay full, but this result is the same thing: poor cash flow. And, you started your business, you're a smart person, you know what you're doing. And I don't even really think this is your fault, because as business owners, we're not trained to focus on the right thing. We're trained to focus on revenue. If we can just generate enough revenue, we'll have a profit, right? If I can just grow my business to a certain size, I'll have a profit. Increase sales, develop new products, keep a full pipeline. The focus is always on revenue. And focus on revenue isn't a bad thing. It's part of owning a business. But think about this. What if we're focused on the wrong thing? What if you made a change from focusing on revenue to focusing on profit? Now, unfortunately, because I am an accountant, we're going to have to talk about accounting for just a little while, just a few minutes. Okay, under the GAAP formula, and GAAP is generally accepted accounting principles, under the GAAP formula for determining a business's profit is sales minus expenses equal profit. This formula is logical, simple, and clear. But while logically accurate, this formula doesn't account for human behavior. That's the flaw in the formula. If in the GAAP formula, profit is a leftover. It's at the end of the formula. It's a final consideration. It's something that hopefully is a nice surprise at the end of the year. For many small businesses, the profit is rarely there, and the business continues on with its check-to-check survival. In my opinion, there are two flaws in this GAAP formula. And for me to say that's a really big deal because I'm an accountant. I have to follow this formula when I'm preparing financials, right? I think one of the fundamental flaws is that this formula goes against human nature. No matter how much income we generate, we're always going to find a way to spend that income, all of it. And then a secondary flaw is that GAAP teaches us to focus on sales and expenses first. Once again, it goes against human nature, which urges us to grow what we focus on. We focus on what comes first, which is sales and expenses, and actually become blind to what comes last, which is profit. So to expand on this point, I want to go through a quick exercise with you in human behavior. Let's look at something called the primacy effect. The primacy effect is the theory that we place additional significance on whatever we encounter first. So let's go through an example of this. In the next slide, I'm going to show you two sets of words. One set describes a sinner, and one set describes a saint. The goal is, as quickly as possible, to determine which is which. Okay, so we've got this set of words here, and let's read through them. Number one set is evil, hate, anger, joy, care, love. The second set says love, care, joy, anger, hate, evil. At first glance, you identified the first set of words to be the sinner and the second set of words to be the saint. And if you did, that's great news because it means you are a human being and you are experiencing the primacy effect. Now, if you're like me and you're the type of person that tried to figure out what the catch is as you were going through the exercise, then that's great news too. It means you're an entrepreneur and you are more than willing to break old systems. So let's just look at the set of words again. And you will see that both sets of words are identical. They're just in opposite sequence from each other. So when you see evil and hate at the start of a set of words, your mind assigns greater weight to those words and less weight to the remaining words. When the set started with love and care, you put the weight there. Now, I know you're probably thinking right now, what does this have to do with my business being profitable? Well, I'm going to get to that. When we follow the conventional formula of sales minus expenses equal profit, we're primed to focus on those first two words, sales and expenses, and treat profit as an afterthought. We then behave accordingly. We sell as hard as we can. We use the money that we collect to pay expenses. We stay stuck in the cycle of selling to pay bills over and over again and wondering why we never see any profit. So when we flip the formula to sales minus profit equal expenses, we're primed to focus on profit. So that's one exercise in human behavior. And I have one more lesson in human behavior to go through. Parkinson's law. Cyril Northcote Parkinson is a British naval historian and author that theorized that our demand for a resource increases to meet the supply of it. That's why when we're given 2 weeks to do a project, it takes 2 weeks. If we're given 8 weeks to do the same project, it will take 8 weeks. That's why when given $1,000 to complete our work, we get it done with $1,000. If we're given $10,000, it takes $10,000. And you may be asking yourself, well, that's great, but why this tube of toothpaste? Well, Parkinson's law applies to toothpaste as well. It's why when you're at the end of the toothpaste tube and you forgot to go buy more toothpaste, you are squeezing the heck out of that toothpaste tube to get a little pea-sized bead of toothpaste so you can brush your teeth. I mean, I've even gone as far as to like cut the tube so I can kind of dig down into the cap and get the toothpaste. So we become really resourceful when we need to get that little last bit of toothpaste. The profit first system makes Parkinson's law an asset. By taking profit first, the money available for expenses lessens, and we're forced to find ways to get the same things done for less money. It forces us to run our businesses leaner, tighter, and more efficiently. We're forced to get innovative. And I'm almost done with our lesson in human behavior. Accountants define profit differently than entrepreneurs. We actually point you to a number at the end of your profit and loss statement, and that number doesn't necessarily correlate with the money you have in your bank account. An entrepreneur's definition of profit is simple. It's cash in the bank, cold, hard, tangible cash. The bottom line for an entrepreneur is that cash is all that counts. It is the lifeblood of your business. Do you have it or not? If you don't, you're in trouble. If you do, you're sustained. And while we know that we should read our profit and loss, cash flow, and balance sheets regularly, conduct financial analysis, and scour our general ledgers, we don't. Business owners don't have time for that stuff, and accountants know this. We've seen you lose focus and go to sleep when we review your financials with you. So what do you do when you want to see how much money you have to run your business? You check your bank account balance online. Even I do that, and I'm an accountant. I don't automatically pull up my accounting software and go, okay, I've got this much money in the bank. I go online and look. Parkinson's law dictates as deposits increase, so does our spending, and vice versa. Hence, most businesses have extremely volatile financial trends and rarely have a profit. But if you take your profit first, your natural behavior becomes your biggest asset. To run a profitable business, you really need a super simple system to manage your cash, one you can understand within seconds without help from an accountant. You need a system designed for normal, busy entrepreneurs and not nerdy accountants like me. Profit First is that system. Parkinson's law becomes a powerful ally when you take your profit first and you're forced to grow your business off the remainder. Under the traditional accounting formula, profit is a leftover. When you take your profit first, expenses are forced to adjust to what remains after profit. You become innovative. You figure out the things that make profit and dump the things that don't. When you focus on profit first, you inevitably figure out how to make a profit consistently. Under the profit first methodology, bank balance accounting becomes a highly effective method of managing your finances. And it fits in with human behavior. We have proof that taking your profit first works. How? We have a lot of historical proof. The 401k has been the greatest savings mechanism in U.S. history. Your 401k contribution comes out of your paycheck first. Your paycheck's deposited into your bank account. You never even miss that money. You're taking your profit first. The profit first methodology is based on 4 core principles, which oddly correlates to dietary science. The first principle is to use small plates. In 2012, a report in the Journal of Consumer Research concluded that the average plate size in America had grown from 23% between the years 1900 and 2012. That's from 9.6 inches to 11.8 inches. The article went on to explain that should this increase in plate size encourage an individual to consume 50 more calories per day, that person would put on an extra 5 pounds of weight each year. Year after year, that adds up to one chunky monkey. Using smaller plates starts a chain reaction. When you use a small plate, you get smaller portions, which means you take in fewer calories. When you take in fewer calories than you need, you start to lose weight. Profit First forces you to use smaller plates. Forgot to scroll down here. It forces you to use smaller plates to pay your expenses, and you start cutting unnecessary expenses. The second core principle is to serve sequentially. If you eat your vegetables first, which are rich in nutrients and vitamins, they will start satisfying your hunger. When you move on to the next course, you will automatically eat less. By changing the sequence of your meals, by eating your veggies first, you bring nutritional balance to your diet. This correlates to the primacy effect that we talked about earlier, because in this instance, when we serve sequentially, we are focusing on your profit first. The third core principle is to remove temptation. Dietitians urge us to remove any temptation from where you eat. People are driven by inconvenience. If you don't have any junk food in the house, you're probably not going to run to the store to get it. I mean, in this day and age, that would mean putting on pants and combing your hair. Why would we want to do that? You're more than likely going to eat the healthy food you stocked instead. Oh, money works the same way. As you implement profit first, you're going to use the powerful force of out of sight, out of mind. As you generate profit, you're going to remove the money from your immediate access. You won't see it, so you won't access it. And just like anything that you don't have a reasonable degree of access to, you will find a way to work with what you do have and not worry about what you don't. The fourth principle of profit first is to enforce a rhythm. If you wait until you're hungry to eat, it's already too late and you'll binge. Then you're likely to eat too much and stuff yourself. You go from starving to stuffed and back to starving again. These peaks and valleys in your hunger result in way too much calorie consumption. Instead, researchers tell us to eat small meals regularly throughout the day so you don't get too hungry. Enforcing a rhythm works with money too. When we get into a rhythm, we don't get into the reactive mode of crazy spending when we get big deposits and panicking in the face of big cash dips. Now, I'm not saying that money's going to appear magically overnight from the system, but over time, you'll always have cash at your disposal by establishing a rhythm that will get you out of the daily panic. This system is an easy way to measure cash flow. And instead of reading your cash flow statement, which we know you're not going to do anyway, you can measure your cash flow by just checking your bank accounts, which you do on a daily basis. Okay, let's talk about these four principles in a little greater detail, and we'll work the implementation of Profit First into this as well. Under the Profit First methodology, you are going to set up additional bank accounts that will serve as your small plates. Your income account. When money comes into your income account, it acts as a serving tray for your other accounts. This is the account where all of your revenue will be deposited. It will essentially work as a clearing account. On your allocation days, you will move funds from this account to your profit account, your owner's pay account, your tax account, and your OPEX account, using targeted allocation percentages based on your annual revenue. The profit account. This is the account where your profit will be allocated. It's the funds where you will receive your profit distributions, and also serve as your rainy day fund if you want something like that. If you've never had a profit, then you need to start really simply and slow, what I like to call low and slow, by putting aside 1% of every deposit you receive into this account. The owner's pay account. This account is where owner's compensation will be allocated. Gone are the days when you paid everyone but yourself, because you're your business's most important employee. Remember, your business serves you and you're not in service to your business. Owner's comp is the money we reserve for you and any other owner-operators of the business to get paid for the work you do for the company. Your salary should be on par with the going rate for the work you do. In other words, the salary you would have to pay a replacement. If you haven't been receiving a salary, again, start low and slow. Start with a low percentage allocation and work up from there on a quarterly basis. Your tax account. This is the account designed to pay the direct income tax liabilities of the business. And this is huge, it also pays the personal income taxes of the owners. Let me reiterate, your company will reserve your personal income tax liability for you and then pay it. So when your taxes are due and you send in your quarterly payments, the company will send the payment in for you. This system also works if you have taxes drawn from your paycheck, because then the company will reimburse you for those taxes. Now, the operating expense account, or the OPEX. This is the account you're going to use to pay all of your operating expenses, including employee salaries. At this point, you might be asking, how do I know how much to put in each account? Well, this next slide is a chart of recommended target percentages that you should shoot for, and it's broken out by revenue range and then the allocations of what you want to eventually get up to, or what you should be up to for a healthy company of your size. You would follow this chart. And a lot of detail and preparation goes into this chart. So I'm not going to spend too much time on it because I think that's a whole nother webinar in itself. But just so you know where we're getting the numbers from. And this chart is also in the Profit First book. All right, the second principle, serve sequentially. You're going to be taking a percentage of the money that comes into the income account and dispersing or allocating to your other accounts and to clear out the income account. Again, set percentages and start small. I would just, if you've never ever taken a profit from your business before, I would just start with 1%. I mean, it's just a starting point, and then I would increase that over small percentages on a quarterly basis. Starting big usually doesn't work because it's just too much of a change to make all at once. In this system, you're changing your mindset and you're developing habits. And so you need to start slowly so that, number one, you can make the changes and they won't hurt your business. And number two, so you can start getting into the habit of these changes and into the rhythm. So just to go through this a little bit, let's take an income of $1,000. 1% or $10 goes to profit, 1% or $10 goes to owner pay, and 1%, $10 to the tax account. The remainder goes to the operating account, so $70 to cover your operating expenses. Now that's just a simple example. It can get more, well, less simple. How about that? All right, the third principle is to remove temptation. Out of sight, out of mind. And this is where you've got money sitting in your profit account and your tax account. And if you're logging into your bank account to check your account balances every day, it might be a little bit too tempting to take that money. Maybe an emergency expense came up that you didn't plan for or something like that. We really don't want you to touch this money because we want you to get into the habit of taking your profit first. So what the book recommends and what I recommend is, if this is just too much of a temptation to see when you're logging onto your regular bank account, open 2 other accounts at a totally different bank, preferably one that it's hard to get the money out. And you're going to move the money from the profit and the tax account to a profit hold and a tax hold account at the second bank. So that's removing the temptation. And I know at this point you probably think I'm crazy about even suggesting that you're going to have 7 bank accounts for your business to keep up with. You're thinking, I've lost my mind. It's going to add a whole bunch of time for your bookkeeper to reconcile these accounts. And your banker's going to think you're crazy. That's another pushback that I've received. Your banker is going to jump for joy if you want to open these accounts because they get paid a commission for new accounts. So I know I called my bank to open these accounts, and I mean, it was nothing. It was like, okay, you want 5 accounts? No problem. Because I actually moved banks too because I found a cheaper bank. And they've been great. They've been great to work with. So you can find banks out there that will work with you. And I think the other pushback that I get is, what about bank fees for these accounts? Well, you're going to negotiate those. If a bank wants to charge you a lot in fees for these accounts, walk away, because there's banks that will work with you and not charge fees. And essentially, I mean, really, you're collecting money in the income account and you're paying money out of your OPEX account. So really, these other accounts, they're just for transfers and things like that. They're just holding accounts. Okay, and it really doesn't take a whole bunch of additional time to reconcile these accounts because, again, you're just transferring back and forth a couple of times a month, just whatever rhythm you get on. So it's really not that much additional work. Okay. And then this is just another slide, which kind of shows you the flow. Let's talk about allocation and rhythm. How often do you make your allocations? Well, that depends on your business and the flow of your business. Some people, like realtors, they'll make their allocations monthly. Some do the 10th and the 25th of the month. Me personally, I do a biweekly allocation the day before payroll. And that's just my natural kind of accounting rhythm anyway. I always like to make sure that I have money in the account for the next payroll that's coming up. And I like to have that money in the account 2 weeks before that. So that's just how I like to work. That's what makes me comfortable. But I do my allocations bi-weekly. And it never takes me more than 10 minutes to make my allocations. I have my target allocation percentages for the quarter set out. And I know I look and see what came into my income account during that period. And I just do my allocations from there. It really doesn't take long at all. A fully rolled out Profit First plan can take 18 to 24 months for you to hit your optimal targets. And again, just go slow. As you're increasing your allocations to your profit, owner's comp, and tax account, you're either lowering your expenses, or you're increasing sales, or you are increasing your margins. You're working within those parameters so that this will work for you. So you say, okay, this all sounds great. Where's the proof? Well, I know Profit First works because I've implemented it in my business. And it works so well. And I just love the program so much. And I saw how it could help so many businesses that I became a certified Profit First professional so I could help other business owners implement the system. And an example of how the system has helped me, I'm going to give you 2 examples, but the first example is owner's comp. I own an accounting firm. My work is typically seasonal. While I do have some bookkeeping and accounting and coaching that recurs on a monthly basis, our big season is tax season. So I have more revenue coming into my business in February, March, and April. It kind of levels out a little bit in May, June, July, and then it picks back up again in August, September, and October with the tax extensions being due. And then the hardest months for my business are November, December, and January, just because I just don't have that huge cash inflow. And many is the year that during November, December, and January, I have gone without taking a paycheck so that I could pay my business expenses and make sure that any employees I had were paid. So here's an example of the owner's comp for me. I implemented Profit First in my business in July 2020. Had an allocation plan set up and all of that. I followed that plan. And of course, we had some nice revenue numbers in August, September, October. And I put my percentage of that revenue aside for my owner's comp. And I'm happy to say the proof is in the pudding. I was able to give myself my normal payroll check for November, December, and January. And for my business, January was a 3 payroll month. So I've been able to cover all of that. And it's a wonderful feeling. I didn't have to go home and say, well, honey, I'm not going to pay myself, during these months and things like that. So it's taken a lot of stressors off of me. All right. And then story number 2 for me is the tax account. The tax account has become my favorite account. And I think like the story of the cobbler's children who has no shoes, I'm doing everybody else's taxes and planning and bookkeeping, and I'm awful at planning for my own. And I usually literally leave it up to, April 14th when I have to see what I need to pay in with my extension. But I think with making these allocations to a tax account, it's made me keep a better eye on my business's overall tax situation, and it's made me more intentional. So, and in keeping with that, I've been able to make quarterly estimated tax payments. for 2020, and I was very curious to see how I was going to end up for the year. And I've already got my business returns prepped and my personal tax return prepped, and this system worked beautifully. I'm not going to have to send in an extension payment. I'm not going to have to send in, any additional on April 15th. My taxes are covered. They're paid in. I won't have any underpayment penalties or anything like that. So I am good to go. And I'm really excited to see, I've just been doing this plan for 2 quarters. So I'm really excited to see, as I'm working up to my target allocation percentages, what this plan is going to do for me. I would be a little remiss if I didn't tell you how my firm can help you implement Profit First into your business. Because while Profit First is simple conceptually, it's not always easy because each business is different, right? You have different situations arise. You have different goals. And so we really like to build relationships and partnerships with our clients. And so how this would typically work is phase 1, we would do your profit assessment for you, where we're looking at your historical review of your company's financial trends, matched to the best financially performing companies in your category. And we come up with a plan on how to get your business healthy. So then we help with phase 2, which is the Profit First implementation, where we set up, or we help you, we coach you in setting up your bank accounts, and we come up with your allocation percentages and things like that. And we usually build this into it takes 6 to 8 quarters to fully implement this. And then phase 3 is profit maximization, where we do a quarterly process of looking at your profit, owner's pay, and continually improving while leveraging Parkinson's law to build maximum efficiencies and innovations in your business. Okay. So as part of participating in the session today, I would like to offer you a free download of a profit assessment that you can work through. And you can scan the QR code here on the screen, or you can go to leafbookcfo.com/community call. All right. Well, that's all I had for you today. I hope you enjoyed the presentation of Profit First, and please contact me if you have any questions whatsoever.